Will the Federal Reserve buy Bitcoin? It's a question that has been swirling around the financial world, sparking debate and speculation. The answer is complex, intertwined with legal restrictions, economic considerations, and the evolving landscape of digital assets. As Bitcoin's relevance in global finance grows, it's crucial to examine this question thoroughly. This essay delves into the various perspectives surrounding the Federal Reserve's potential acquisition of Bitcoin. We'll analyze recent statements from Federal Reserve Chair Jerome Powell, explore proposed legislation like Senator Lummis's Bitcoin Act of 2024, and delve into research conducted by central banks on Bitcoin's impact on monetary policy. The intersection of traditional finance and the burgeoning world of cryptocurrencies presents unique challenges and opportunities. Examining the Federal Reserve's potential involvement with Bitcoin offers a glimpse into the future of money and the global financial system. Join us as we navigate the intricacies of this evolving landscape and explore the potential implications of the Federal Reserve's stance on Bitcoin. Federal Reserve Chair Jerome Powell has been clear: the Fed is legally prohibited from holding Bitcoin, and they're not looking to change that. These statements, made on December 19, 2024, came in response to President-elect Trump's proposal for a strategic Bitcoin reserve. Despite Trump's pro-crypto stance, Powell emphasized that any legal changes regarding Bitcoin ownership are for Congress to decide, not the Fed. This position isn't new. Powell has consistently reiterated the Fed's lack of interest in holding Bitcoin. He emphasizes that the legal issues surrounding Bitcoin ownership are a matter for Congress to address. The Fed's current focus is on the regulatory framework governing the interaction of traditional banks with crypto assets. This clear stance provides some certainty in an otherwise uncertain landscape. However, the evolving nature of digital assets and the increasing pressure from pro-Bitcoin voices suggest that this story is far from over. Senator Cynthia Lummis's Bitcoin Act of 2024 throws a wrench into the discussion. This bold proposal suggests that the Treasury and Federal Reserve should buy 200,000 Bitcoins annually for 5 years. This would result in an accumulation of 1 million Bitcoins, roughly 5% of the total global supply. This reserve would be held for at least 20 years, acting as a hedge against dollar devaluation and supporting future debt issues. The proposed funding mechanisms include using the Federal Reserve surplus returned to the Treasury and re-evaluating state-held gold certificates. The Act's introduction coincides with a surge in Bitcoin's price, nearing $100,000, fueled by Trump's election victory and his pro-Bitcoin stance. This proposal, while controversial, highlights the growing acceptance of Bitcoin as a legitimate asset class. It also underscores the potential for Bitcoin to play a role in national economic strategies. While the Act's future remains uncertain, its introduction signifies a shift in the conversation surrounding Bitcoin and its place within the traditional financial system. Section 4. Central banks. Take notice. Bitcoin's impact. Central banks and financial institutions around the world are increasingly researching Bitcoin's impact on monetary policy. Studies by institutions like the Minneapolis Federal Reserve, the European Central Bank, and the International Monetary Fund suggest that Bitcoin's disruptive nature could limit central banks' control over economies. The European Central Bank, for instance, has published conflicting papers on Bitcoin. One paper labeled it a failed experiment, while another acknowledged its impact on wealth distribution. These conflicting views highlight the uncertainty and debate surrounding Bitcoin's long-term implications. Bitcoin's price appreciation benefits early holders but may reduce purchasing power for others, even those who don't hold Bitcoin. This potential for economic disruption is a key concern for central banks. Bitcoin's increasing adoption could hinder their ability to dictate monetary policy, a long-standing goal of Bitcoin enthusiasts. Section 5. The Fed's Crypto Crackdown. New banking restrictions. The Federal Reserve has issued new restrictions on crypto banking, aiming to prohibit member banks from holding most crypto assets. Banks wishing to use dollar tokens need to demonstrate robust security measures and receive approval from the Fed. These restrictions cite various risks associated with cryptocurrency, including fraud, legal ambiguity, and volatility. The Fed is clearly concerned about the potential for cryptocurrencies to destabilize the traditional banking system. Additionally, the Fed released guidance on supervising novel activities and stablecoin engagement by state member banks. This guidance addresses issues like crypto safekeeping, customer transactions, collateralized lending, stablecoin issuance, and holding crypto assets. The message is clear. The Fed is closely scrutinizing the crypto industry and its potential impact on the financial system. These restrictions have sparked debate, with some arguing that they stifle innovation and limit the growth of the crypto industry. Others, however, applaud the Fed's cautious approach, emphasizing the need for consumer protection and financial stability.